In this video, we discuss deferred taxes. The tax expense that a company reports on its GAAP or IFRS-based income statement does not equal the actual cash taxes that were paid during the period. And those differences are represented on the financial statements as deferred tax assets and liabilities. Now, before we get into what deferred taxes really are, the first question to answer is why don't GAAP and taxes and actual taxes equal? Companies prepare two sets of financial statements, one for the IRS using tax accounting rules, and one for investors using US GAAP. Companies calculate their actual tax obligations using the relevant country's tax code, which we'll just call the tax rules, while the tax expense on the income statement is calculated using the relevant local book rules, like US GAAP or IFRS. Book and tax rules are not always the same. So for example, one of US GAAP's goals is to get companies to make conservative revenue recognition assumptions to better inform investors. The IRS goals are different. The IRS goals are to collect taxes, and that leads to a more aggressive revenue recognition policy. And these divergent goals sometimes lead to different accounting rules. The different accounting rules primarily revolving around the recognition of revenue that we just talked about, but also the calculation of depreciation, how quickly assets are depreciated, and lastly, how losses are treated, create many of the differences between the tax expense and the actual taxes paid. Although certainly those three are not exhaustive. There are many things that create these differences because of the different accounting treatments. But the three that we just mentioned are ones that actually tend to generate a lot of the deferred taxes. Let's break this down into a little bit more detail. So the taxes that a company reports on its income statement for book purposes, in accordance with the book rules, are comprised of two components. The total expense that you see one line item on the income statement, but really that one line item is comprised of two things. The cash taxes paid to the IRS, or the current liability, or the current tax payable. And then the second component is the deferred tax assets and liabilities that are likely created during that period. Deferred tax assets and liabilities are caused by temporary timing differences between the accounting of expenses and income for book purposes and the accounting for expenses and income for tax purposes. So the simplest example, and probably the most common example of what creates these types of differences, is associated with depreciation. Specifically, while most companies choose straight line depreciation under GAAP, both US GAAP and IFRS, the IRS, for example, in the United States, requires an accelerated depreciation, which from a tax standpoint, companies are happy to do. For tax purposes, it leads to a lower taxable income. The more depreciation you take up front, the less taxable income you have to pay taxes on in earlier periods. And obviously, for companies that are growing, that are constantly buying new machinery, the accelerated depreciation approach will, for the foreseeable future, lead to lower tax obligations than a straight line approach. So we have this disconnect between straight line depreciation, which is what most companies elect to do under US GAAP, and accelerated depreciation, which is what is required, and companies are all too happy to oblige for tax purposes. The difference means that for earlier periods, book depreciation, as we just mentioned, will be lower than tax depreciation. And this will create a deferred tax liability until book depreciation will be higher than tax depreciation towards the end of the asset's useful life. Obviously, this is a pure temporary difference. Whether or not you accelerate the depreciation or do straight line, you're going to depreciate the same amount. The question is, are you going to depreciate a lot of it in the beginning, or are you going to depreciate it evenly over time? In terms of the cash flow statement impact of deferred taxes, year-over-year increases in deferred tax assets are reflected as negative adjustments to net income in the cash flow statement under the cash from operations section. Just like working capital items, just like in the same way that working capital assets like accounts receivable increases from one period to the next are reflected as negative adjustments to net income in the cash from operations section, the exact same thing happens to deferred tax assets, while increases in deferred tax liabilities are reflected as positive adjustments. So similar to how accounts payable year-over-year increases lead to positive adjustments to cash from operations, the same thing is happening to deferred tax liabilities. Now, from a conceptual standpoint, understand that an increase in deferred tax assets during the period means that the tax expense line reported on the income statement reflects an expense that is lower than the real tax obligation during the period, and thus should be adjusted down on the cash flow statement to get real cash flows. That's why the increase in deferred tax assets needs to be reflected as a reduction to cash from operations, from net income down to get to cash from operations. Conversely, an increase in deferred tax liabilities means that the tax expense line on the income statement reflects an expense that is higher than the real tax obligation and thus needs to be adjusted up on the cash flow statement to get to real cash flows. In other words, you're recognizing this larger tax expense in the actual cash tax liability, and so we want to adjust that on the cash flow statement to get to real cash flows. As the deferred tax liability is going up, we need to adjust it to reflect the fact that cash didn't actually go out the door. Again, before we go into an exercise, let's actually see how companies actually report this. So if you look at Apple's footnote, for those of you who took our standard accounting class and went through the standard accounting videos, you may recall that Apple has a footnote disclosure of what portion of the tax expense it recognizes on the income statement. And you see this is Apple's income statement. There's about $13 billion in the fiscal year 2013 in tax liability. But then the footnote identifies which portions of that are current versus deferred. So let's take a look at the federal. So on a federal level, the company actually had a current tax obligation of only $9.3 billion, but $1.8 billion of the total book obligation of $11.2 billion, $1.8 billion of that is deferred. On a state, it's the opposite. The total obligation was $773 million. The current obligation was actually higher. And on a foreign basis, same thing. The current obligation is actually higher than what was recognized on the income statement. And so if you get to the total 13.118, which is the same here and here, recognize that their tax obligation, their current tax obligation, if you add all three of these up, is actually $1.1 billion lower than the reported obligation. And it's these deferred tax assets and liabilities that capture those differences and ultimately cycle themselves out in future years as these temporary timing differences are eliminated. Now, on the cash flow statement for Apple, that $1.141 billion, the summation of all of these three line items, $1.141 billion, is added back to the cash flow statement under the cash from operations section. And that has to do with the logic that we just talked about. You are presenting a tax obligation of $13 billion, but you only paid $12 billion or so. So if you're trying to get from net income to cash in my pocket profit or cash from operations, you need to recognize that net income is understated by $1 billion because of all these deferrals. From a presentation standpoint on the balance sheet, understand that deferred taxes are reported both as assets and liabilities, as opposed to some net deferred tax liability or net deferred asset. Some folks wonder why you don't just see a net deferred item. And the reason is the nature of things that lead to deferred tax assets and deferred tax liabilities are very different, as we're going to see it in the exercises that come forward. Under US GAAP and under IFRS, you actually recognize both of them separately.